Good morning and welcome to the OFX Currency Corner. The Australian dollar suffered wholesale losses at the end of last week as equities drove a wide rally for the US dollar across major counterparts, gaining strongly against the euro, pound, New Zealand dollar, yen, and of course our own currency as well. We fell below that 78-cent handle briefly, touching lows at 77.89, the first time since December and in fact this year. And the reason for that really was nervousness within the markets, driven by a sell-off in equities as wage growth in the US stems concerns that perhaps inflation will begin to pick up at a faster pace, and that will lead to a hawkish Federal Reserve pushing the pace of interest rate hikes ahead of the three that are planned currently. And that tighter normalisation of monetary policy has left investors nervous and weighed on risk assets, and that includes the Australian dollar. Where we go from here in this week definitely depends on risk sentiment, and we'll be keenly watching that this week. A key outlook to that or addendum in governing direction through the week ahead will be inflation expectations. Wednesday we have the CPI report due out of the US, and a surprise to the upside could fuel this risk-off sentiment and drive those concerns that normalisation to monetary policy will happen at a faster pace. In saying that, though, these wage growth issues or wage growth levels that we're seeing across the world aren't flowing into underlying macroeconomic indicators like inflation, like gross domestic product. So until we start to see that, I don't feel that the Reserve Bank, the Federal Reserve, will push a tighter path to monetary policy normalisation, and we will continue to see gradual rate hikes. Last week's statement of monetary policy suggests that the RBA will leave rates on hold well into 2018, if not into 2019, and a strong labour market print will be unlikely to push that. So we'll be looking at ranges this week between 77.30 and 79.30.